Hey, hi. So in this video, I am going to walk you through the financial statement analysis of a healthcare provider. Okay, and so this healthcare provider is Kowai Medical Center and Hospital, which is based out of Coimbatore. Okay, and I'm going to do more financial statement analysis videos for companies operating in different industries. Okay, like FMCG, manufacturing, retail, and the financial services as well. Okay, so so these are the learning objectives of this session. And by the way, before we kind of go any further, if in case you have a good you have a decent understanding of financial statement, then that's great. But if in case you don't, and so then I would strongly recommend that you watch my video on financial statements. Okay, so I'll link it in the description section. All right. Okay. So that's it. Let's get started. So there are three learning objectives in this video. One is you'll understand how this hospital, how this company has allocated capital and what they've done with that capital over time. That is through a balance sheet analysis. Okay. And then we'll also, with that backdrop, with when we understand how they've allocated capital over time, with that backdrop, it will become easier for us to, uh, you know, interpret key financial ratios. Okay, I don't want to like focus on the calculation part per se, the formula calculation, because you can find it in Google and textbooks. I want to focus on how do you interpret those financial ratios, and with the backdrop of capital allocation, it becomes easy to kind of understand. All right, and then so when we uh, analyze these financial ratios, okay, we would definitely run into areas which would need further investigation. Okay, so you'll come up with questions to which we need to seek answers to. All right. So yeah, so we then obviously need to dig further. All right. So these are three learning objectives. All right. So let's get started. Okay. So first, a little bit about the company. So this hospital, yeah, uh, was started back in 1990 in Coimbatore with 200 bed capacity, and now the capacity has increased 11-fold. Okay, and they also have satellite centers. I think they have 4 satellite centers in and around Coimbatore. Okay, and they have a main center based out of Coimbatore. Okay? And they also started a medical college recently. They started back in 2020. Now this year, was the 4th year of its operation. Okay, all right, and the student intake is around 150 annually. All right, okay, and the company right now is trading at a market cap of I think 3,300 uh, uh, CR. All right. So with that, let's first quickly just scan through the financial statement before we kind of. All right. So balance sheet is a summary of financial statements which tell you that as of today, that is end of fiscal year 2023, cumulatively, uh, what what debt and what equity does the firm have, okay, and then using those sources of funds, what assets have the firm have been able to, or how much worth of assets has the firm been able to accumulate until now. All right, that's what it tells you. All right, so if you look at this balance sheet, back in 2018 it had 480 CR worth of non-current assets. Bulk of it was property, plant and equipment, hospital buildings, medical equipment. All right, and now this has more than doubled to more than 1,000 CR. Okay, and most of it I think is due to uh, the medical college that they built back in 2019. Okay? It wasn't that it was built completely in 2019. They started work on it in 2019. All right, and so it came into operation 2020. And as I said, right now it's in its fourth year of operation. All right. So, 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 so the key highlight is that they have been adding capacity. All right. And along with that, there has been a rise in current assets as well. Okay. There has not been a much rise in inventory, which is actually very typical with hospitals. Receivables, again, it's a small number, but there has been a minor rise. In fact, receivables is becoming a challenge now for hospitals in India, especially with increasing health insurance penetration. And I'll touch upon it when why we dig into financial ratios. Okay, and the other highlight is cash has been increasing, so which is a good sign. All right, we look at the source of funds side, we see that equity has been on the rise. The loan, the long-term loan, it has been increasing as well. So it tells us, that the capacity expansion has been debt funded. Okay. All right. So that's the impression that we get when we look at this. All right. So now let's quickly jump to the P&L. Okay. So P&L. Uh, so if you take a look at the revenue, let me click on this. So healthcare revenue, we see it has increased from 580 CR to 950, which is 1.6x. Medical college, it's a small number right now. It's in fourth year for operations, so it's contributing around 6.5% of revenue right now. Okay. Next year it should peak, unless of course they decide to increase the annual intake from 150 to more. Yeah, right. Uh, then there are some direct and indirect cost line items, and again I'll cover them in detail when when we get to the financial ratio, which would be up next. All right. So look at earnings before interest and tax. All right. Let's see how much has this increased. So this has, all right, sorry, this should be, this is increased around 1.7x. So slightly, sorry. All right. So earnings before interest and tax has increased around 1.9 times, so slightly more than the revenue. So that means that they have become more profitable over the last 5-6 years. Okay, and earnings before interest and tax is your all your sales. Okay, your sales from operations uh, minus your direct and indirect costs. Okay, and minus your depreciation and amortization. Again, I'll get to what indirect costs are when you get to financial ratios. All right, right now we're just doing a quick scan. Okay, all right. And also, the other important aspect is, if you look at the operating margin of the healthcare and education segment, which I pulled from the notes section of the annual report. So the education segment uh, turned profitable only in 2023. It was not profitable until now, and which is understandable. Okay, all right, because it's not running at its full capacity yet. Next year it will. Okay, so but it looks as if the education sector is actually yielding a slightly higher operating margin than the the hospital or the healthcare segment. Okay, if I do EBIT, so this is around 36% profit margin. That is EBIT education divided by sales from education. Okay, and if I do this 186 divided by healthcare, it is around a little less than 20%. But the contribution is from the medical college is not right now small. Okay, all right. Okay, and now let's turn to cash flow. In the cash flow, the key highlight is, if I look at the cash flow from operations, the last 6 years, it's over 1000 CR of cash flow from operations. And if I compare it with the profitability, okay, it's that is PAT, it's a little over 500. So the cumulative cash flow from operations, it has far exceeded the cumulative profit after tax. All right, which is a good sign, which means that they are generating enough cash and money is not getting stuck in working capital. All right, and again, working capital, some of the other things I'll cover in the when I get to the financial ratio bit. All right, okay. Now let's go back to the balance sheet. Okay, let me remind you, the first objective was understanding capital allocation over time through balance sheet analysis, because with this backdrop, it will become easier to understand and interpret financial ratios. All right, so let's do a quick analysis of this balance sheet. All right, so what I typically find helpful is I look at, because see, balance sheet every year is a snapshot, okay, in time. It's a snapshot of year 2023. All right, and this balance sheet from 2022 is a snapshot from the end of year 2022. So what I find useful is if I compute the difference, say between this line item, all right, between say property, plant and equipment in 2023 and 2022, right, and see how this number has evolved year on year. Okay, so right now this is 2020. Let me write it here: 2022 to 2023. Okay, and if I drag and drop this, okay, let me drag and drop. Okay. All right. And I'm concerned not about the totals. I'm not interested in looking at how the totals have changed year on year, but more so how the individual line items have evolved, and if there are any significant magnitude items, that that come across. So we'll focus on them. Okay. Let me just do this quickly. I'll tell you what I'm trying to do. Let me first clean this up. All right. Okay. So let's make this source. Let's make this application. Okay. So let's move this to the application. You'll understand what I'm doing. Let me move this to the application side. Okay. All right. So first, let's talk about the source of funds. Okay. Now, all the negative signs, let's move to the source column. Okay. And let's change it. Let's change the sign. Okay. All right. And so let's do it. Let's do this for all the negative signs. I'm moving all the negative sources to the application side because they're not sources. Any source of fund, okay, which has reduced from 2022-23 is not a source. Okay, it's actually an application of the fund. That's what I'm moving it to the application column. All right, that's what I'm doing. And then it will just become very easy to understand how the balance sheet has evolved over time, how they have allocated capital, what they have done with that capital. All right. And the sources, let me just highlight with, let me just highlight them with, say, orange. Okay. And I'll only highlight the ones which seem like big numbers. I'll just only highlight them. Okay. I'm not concerned with small numbers. And I'll tell you what I'm trying to do. Okay. And let me do the same thing here as well. So in the application side of the balance sheet, okay, all the negative numbers, okay, let's say this number, I know although this is small, okay. So if if the number reduced from 22 to 23, it means it's not an application. it's a source, right? So it needs, I'll move it to the other side. It's not an application of fund, it's basically a source of fund. That's what I'm doing. Okay. Let me do the same thing here as well. Let me use this color scheme. I'll okay. Let me, so basically anything above 10 CR, I'm just highlighting it. All right, because those are numbers I want to see and observe as to what really is happening. Okay. All right. Now let's analyze this. All right. Let me reduce the, let me make it 80. All right. Okay. So if you see, let's first take a look at the orange cells. So if you see, this is, I'm not concerned with that. This is total. All right. All right. So if you see, what are the sources? What are significant sources of funds between year 2022 to 2023? What are the significant sources of funds? One is retained earnings. Okay, that is their own profits. Okay, all right. That that is a significant source of capital. Plus this line item, this payables as well. All this is small. So payables has increased, and retained earnings. So these two sources of capital, okay, have been used to fund what? Have been used to fund capex or fund uh, capital work in progress, to fund capital expansion, okay, and it has been used to fund some other financial assets, okay, which is really deposit with banks for some business reason. And I kind of looked it up. It means that now, because the medical college is affiliated with Dr. MGR University, which is based in Chennai, so they need to kind of park some deposit for that affiliation, and so, plus there are some other deposits as well. All right. So any which ways, the point I'm trying to make is these significant sources of funds are being used to fund their capacity expansion. Okay. A bulk of it is also landing in the bank, okay, as cash on which they are earning interest. Okay. And then a significant portion of it is being used to pay down debt. So that's why you see the debt has reduced, the long-term debt has reduced by 36 CR from 483 to 447. Okay. All right. So you kind of get to know as to really what is really happening with the company. All right. And if you do this, okay, for prior 4 years, we'll get to know what the company has been doing for the last 4 5 years. Chal kya raha hai company mein, you'll get to know. All right, in terms of their capital allocation and how the capital really is moving, okay, across. All right. All right. So I did this analysis for the prior years as well. I changed the sources of funds to orange, the application to yellow. No reason. Okay. The story that's emerging is that uh, in year 2019, 2020, 2021, okay, they took loans, okay, and loans in combination with some of their own money, that is the internal accruals, they use these sources to expand capacity. That's why you see uh, property, plant, and equipment. There has been a buildup in property, plant, equipment. Okay, that's one. Then obviously CWIP, there was an increase in produced because this is capital work in progress. When the work finished, the building was constructed, then it moved to PPE, property plant. All right, that's one theme. Okay. The other theme is, okay, then gradually they started paring down their debt as well, okay, using their own earnings. So if you see, okay, here this loan was in orange because this was a source of fund, but in the year 2022 and 2023, this has turned yellow, meaning it has reduced. So the 67, it reduced from 550 to 480 something. Okay. And then from 480, it reduced to 447. Okay, so they reduce the loan through internal accruals. Okay, because this is the source of funds. All right, and not only that, some of that money, okay, their own money ended up in the bank as well. Okay? So if we see, it was a source of fund in the year 2021. So they used some of their own cash, but then okay, they started producing more cash flow from operations. So not only they paid down their debt, okay, but also it started they started putting it in the bank, okay, and they are earning an interest on that. All right, so that's a story that has emerged. Okay, capacity expansion through debt, and then they paid down the debt through internal accruals. Okay, generated a lot of cash. And then there's some other items that I've highlighted as well, which need further investigation, which not as significant as some of the other items, but still would not hurt. Like uh, other financial liabilities. I see that they use some of the sources of funds to increase their other financial liabilities. Okay, in the year 2020 and then in the year 2022. So it needs to be investigated as to what these two line items are. Okay, so just pick up the annual report from these 2 years and see, all right, why has there been an increase in other financial liabilities? All right, okay, and yes, so yes, this was a otherwise all the other items they are not like as huge. Yeah, there is an increase in lease liabilities because back in 2020 the accounting rules around around renting, changed. So now uh, it appears as a liability, as debt, and so it cannot be expense anymore. So, but that's just accounting. Not going into that in this video. All right. Okay. So, so this kind of gets the sense of the story of the last 5-6 years. Okay, as to what the company has done. Okay. So let's talk about financial ratios for this healthcare provider. Okay. So so these are the ratios that I intend to cover in this session, which is profitability, efficiency, solvency, and return ratios. All right. So before we get started, we kind of dig into these ratios. So in India, what happens is that before considering joining any college, a student looks at his or her ROI, right? What is the ROI they're going to get? Okay. And before investing in mutual funds, investors they look at past returns, and before taking the project, a company estimates the potential return on its future investment. The point I'm trying to make is that for a company or business, okay, return on their invested capital or return on equity, these are perhaps the most important metrics, at the end of the day. Okay, so everything a company does should result in a good return. Uh, while what is good is another discussion, but at the bare minimum, returns should be greater than the cost. Okay, so return on invested capital should be greater than cost of capital. Okay, return on equity should be greater than cost of equities. Right. Okay, and so so what and how do you get to this return? So return, if I were to give you as to this function, return equals return is a function of profitability. Okay? It's a function of efficiency, and then it's a function of capital structure or solvency. So at the end I have return ratios. So this is a function of these three things. Okay, all right, and profitability I know you understand, profitability. Efficiency is how efficiently you're deploying your capital, okay, or how efficiently you are sweating your assets or utilizing your assets. Okay, that's what efficiency is. The third thing, really, solvency is about capital structure. So combination of these three things gives you return, and that is the most, perhaps the most important metric that is tracked by both the firm and the investors. All right. Okay. And the DuPont formula, which we would cover towards the end, okay, gives you the exact relation as to how these three parameters in combination give you the return. All right. All right. So it's not very abstract. All right. All right. Okay. So now with that, let's first talk about profitability. Okay. Now, so if we talk about a healthcare provider, what do you think are the high cost items for a healthcare provider, for a hospital? Okay. So we go to the P&L. Okay. Right. Uh, So I think the high cost items are obviously the doctor cost, the nurses, the support staff, because that is fixed. You still got to pay your doctors, your nurses, even if you have a lower footfall of patients. That's a fixed cost. Okay. The second fixed cost really is the maintenance of all the equipments that you have in the hospitals. Okay, and obviously there are other fixed cost elements as well. Okay, so hospital, this industry is a high fixed cost industry. All right, and so in these line items, employee benefit, that's a fixed cost. Okay, or you could also call it indirect cost. Okay, even other expenses. In other expenses, you have the hospital maintenance, hospital upkeep expenses. So let me just move it here. Okay, so again, this is your fixed or indirect cost. Okay, and that is where the concept of operating leverage kind of plays out. Okay, so say let's say that in a particular month you have say 20 patients coming in, and you have 5 doctors. All right, next month you have more patients, say you have 30 patients, but perhaps you could treat all those patients with the same set of doctors and nurses. Okay, that is what is operating leverage. You had an increase in revenue because you had more number of patients. Okay, but you didn't have to, but your fixed costs, they were more or less like they were constant in the next month. That is what is operating leverage, and that plays out when you like get scale. Okay, all right. So hopefully that made sense. All right, this is your fixed expenses. Now let's estimate what this is really. Okay, so finance groups the fixed, they all the fixed cost line items are grouped under SG&A in finance. Okay, so let's calculate this cost. And SG&A, by the way, stands for selling, general, and administrative expenses. Okay. Let me do revenue from operations. I could do this as well, but I'm just concerned on operations right now. So SG&A. All right. So you see the SG&A cost, it reduced over a period of time. Okay. So what it means is the operating leverage is playing out. That's what it means. All right. Now let's talk about gross margin. Okay. So let's go to the P&L again. So in the P&L, okay, what is a direct cost? Okay. All right. So this cost of medicine and hospital consumables, this is a direct cost. Okay. So the definition of direct cost is the cost that a company incurs in, say, manufacturing a product or providing a service. And in the case of hospitals, it is providing a medical treatment. So what is the cost that they incur in providing providing a medical procedure or a medical treatment? All right. Okay. So in this case, it's cost of medicines and hospital consumables. Okay. So uh, so gross profit really is sales minus this direct cost. That is going to give you gross profit. Okay. So let's estimate that. Estimate the margin first. So this is COGS divided by sales. Okay. And the gross margin is 1 minus COGS. Right. So if you see, the gross margin has been increasing. So typically when you have increasing gross margin, it gives the impression that the company has pricing power. This gave the SG&A margin, the fixed cost, gave the impression that the company has what? The company has operating leverage. Reducing operating margin, just reducing fixed margin, fixed costs. On rising gross margin gives the impression that the company has pricing power. Okay, but before you really conclude that, all right, allow me to take a slight detour, okay, and walk you through and an example for a manufacturing firm. Okay, let's say there's a manufacturing firm. They sell a product for say 100. I think this is percentage, so I'll have to change it into a number. All right. So they say they do sales of 100, okay? And the cost of raw material for them is say 80. Okay. So what's the gross margin? It's 100 minus 80, right? So that's 20. Okay. So what's the gross profit? Sorry, this is the gross profit. I apologize. This is the margin. 20 over sales. All right, 20%. All right. Now say this is year one, and next year there's increase of cost of raw material by 20. So the raw material is now 100. This is raw material is now 100. Okay. So now the company, okay, because it had pricing power, it was able to pass on this increase in cost of raw material to its end customer. So it sold that product for 120. Okay. The gross profit they made is the same. The spread between raw material, okay, and sale, the spread is the same, $20 or 20 rupees or what have you. But the margin dropped from 20% to 16.7%. So although there was a drop in margin, but still the company was able to pass the increase in cost of raw materials to the end customer. So that means the company has pricing power. Okay. So the point I'm trying to drive home is that just by increasing gross margin, it doesn't truly indicate that the company has pricing power. Okay. Although obviously if the cost to provide a service or a medical treatment, they relatively more or less remain constant over this time frame, and the gross margin is increasing, then yeah, you can definitely conclude that this hospital or this company was able to charge higher for its treatment. Okay. So let's take a look at operational ratios. Okay. And in this, so I've pulled this from their annual reports. Okay. In this, just pay attention to the volume of patients. Okay. And then look at average revenue per operating bed. Okay. And look at these two line items here, which is average revenue per patient. So if you see, the volume of inpatients and outpatients is increasing. The volume has increased. Average revenue per operating bed, it increased up till 2021, but then it has been on a decreasing trend. And average revenue per patient, inpatient is patients that are admitted in the hospital, outpatients are patients that are not admitted in the hospital. The average realization per patient, realization is more of an industry word, the realization increased till 2021, but then there was a downhill, there was a fall. Okay. By the way, but what we know is the gross margin has been increasing. So what it means is, okay, the cost to provide a service has reduced as well. So although the revenue, the realization increased, but perhaps the cost to provide a service reduced even further. That's what it means. All right. Okay. All right. Now, so uh, so this was direct cost, and these these line items are indirect. Now there are two other cost line items. One is finance, and the other is amortization, depreciation. All right. So now we looked at direct costs. We looked at indirect costs. So let's look at the operating margin of a company. Okay. So there are two measures of operating performance or operating margin. One is EBITDA and the other is EBIT. So EBITDA, that is earnings before interest, tax, depreciation, and amortization, is sales minus direct cost minus indirect cost. As simple as that. Okay. So this revenue from operations minus direct cost and minus indirect costs. Sorry, I forgot to divide it by sales. Right. No surprise, it has been on an increasing trend because both COGS and SG&A, they have been reducing. That is, both gross margin and SG&A margin, they have been increasing. That's why EBITDA margin obviously would increase as well. And the second measure of operating performance is EBIT. It doesn't have, you have to exclude depreciation amortization from sales as well, and then you'll get EBIT. Okay. All right. So this is, you go to revenue from operations minus direct cost minus indirect minus remove depreciation and amortization as well. Okay. And then you divide it by revenue from operations. Okay. All right. Okay. All right. So again, no surprise, this has been an increasing trend. All right. Now let's take a look at the interest cost. Okay. And so the interest, let me pull this finance cost divided by the total debt, both long term and short term. Okay. So if you look at this, the interest cost right now in 23 and in 2022, it was above 8%. In 2018, it was almost 8%. But these 3 years, it was much below 8%. Okay. The government of India itself borrows little over 7%. The government security, the yield is a little over 7%. So how they can borrow uh, below 7%? Okay, so that needs to be investigated. There could be two things that could be happening. Either they could be capitalizing their interest costs, okay, or they could be they could have had some of these loans could be foreign loans, in the US, the interest cost is lower than in India, right? For example, so that needs to be investigated, right? Okay. Now let's so that completes our all the line items that make up the P&L, that the profitability. Right. Now let's talk about efficiency. Okay. So efficiency, or turnover. So efficiency means the efficiency with which the company is deploying capital, or the efficiency with which it is sweating its assets, or efficiency with which it is utilizing its assets. All right. So, uh, it's also called turnover. So turnover meaning uh, the sales which the company generates on, say, every dollar worth of assets. That is basically asset turnover ratio. Okay. All right. And there are different turnover ratios, to measure efficiency. One is the asset turnover ratio, which is sales by total assets. The other is the fixed asset turnover. So it is uh, the sales which the company is generating uh, per on every dollar of net fixed assets. And the third one is capital efficiency itself. So it is basically sales divided by invested capital. All right. And we'll talk about this in a little bit more detail. All right. So first, let's estimate asset turnover. It is sales. Let's I'll look at total revenue in this case, because it's total denominator. It has total assets. So the total assets are this. Okay. So if you see, this is a very capital intensive industry. The sales, the asset turnover, it's it's almost one. It was almost 1 in 2018, and now it has fallen, and it's 0.7. Okay. So it's that means it's hardly generating 1 rupee on every 1 rupee worth of asset. Okay. And it has fallen down. The reason why it fell down is because they did a lot of capacity expansion. They built this medical college. That's why, and obviously it takes a while for capacity expansions, to reach optimal level of utilization. Now, right now they are at fourth year of the medical college in its fourth year of operation. So year 2024, you may have a better view of their overall asset turnover. Okay. So that's the reason why there was a dip, and then now it's slightly improving, right? And fixed asset turnover, if you just talk about not the overall assets, but just their fixed assets, right? So let's take a look at uh, revenue. Again, since we're talking about just the fixed assets, so I just would want to focus on the operational revenue. Okay, so that's what I take in the numerator. In the denominator, I will take uh, the fixed assets alone. So fixed assets, you have, in fact, we can take all the non-current assets. Yeah. Right. So again, similar story here as well. It's slightly more than one, because obviously numerator denominator is smaller. We're just talking about uh, the sales that they are generating on just their fixed assets alone. All right. And now let's talk about capital efficiency. All right. That is the sales on invested capital. Now, first let's understand invested capital, right? So there are two ways in which you could estimate invested capital. Okay. One is that if you take a look at if you derive invested capital from the equity and liability side of the balance sheet, okay, which is invested capital is equity, book value of equity plus book value of debt minus cash, which is basically net debt, equity plus net debt. All right. So that's one way to derive invested capital. And the other way to derive invested capital is if you look at in the asset side of this application of funds side of the balance sheet. Okay. And McKinsey uses this, and a lot of consulting firms, including the consulting firm for which I work, we use this way to estimate invested capital. Okay, so invested capital is net PPE plus operational working capital, which is basically the non-cash working capital. Okay, and I'll explain what it is. And then any goodwill, any intangibles, and any other assets. Okay. So this is what invested capital is, right? So net PPE, we already have that in our balance sheet. This is what is net PPE. This is actually net PPE, not gross PPE. This is net PPE because I did net. So depreciation has already been netted out from this amount. So this is net PPE. So we already have that. Now, what is operational working capital? What is working capital, by the way? All right, working capital is the short-term liquidity. All right. So, and the way you estimate operational working capital is, okay, let's do that. And it will be, and let me put in a separate line item because we would need that when we actually value this company. Okay, we'll have to project out future working capital based upon its past working capital trends. All right. So let me put this as a separate item. And so how do you estimate that? It's basically current assets minus non-interest bearing liabilities, current liabilities. Okay. Right. And why we are saying operational? Because we are not considering cash in this working capital estimation, because cash is, technically speaking, it's a current asset, but we're not considering that as part of current assets in this calculation. And the reason is because cash is something which is sitting in the bank. It's earning you an interest, but it's not really involved in your operations per se. All right, that's why it's being considered out of this calculation, right? And current liabilities, we are only considering non-interest bearing liabilities. All right, so let's estimate this. Let's go to, so what are current assets? Current assets minus cash minus bank balance. All right, now let's take a look at the liabilities. In the current liabilities, let's ignore loan because it's interest bearing. Lease liabilities technically is also interest bearing. More on lease liabilities later. And then minus payables, minus other financial liabilities, minus other current liabilities, provisions, current tax liabilities, all of that. All right. Okay. So that is my current liability, and it's totally fine if it's negative. All right. So we see the operational working capital is negative the way we've estimated it, because it is negative because we've not considered cash in current assets. If we consider cash, it would be sufficient to meet the current liabilities, okay, as well. All right. So let's and yeah, we could spend time discussing current ratios and quick ratios, but let's first estimate this invested capital. Okay. Otherwise, this video is going to get really long. So net PPE, we already have net PPE. Okay. And we have operational working capital that we just estimated. And then let's take goodwill, intangible, and all the other assets. Okay, in fact, I'll take all of these. Sorry, I think I double counted this. good formula? No. Okay. All right. So this is my invested capital. Okay. Now let me estimate capital efficiency. How much sale I'm making per dollar of invested capital. That's what capital efficiency is. All right. Again, it's more than fixed asset turnover because invested capital, the way they estimated, it's lower than your fixed assets, right? But the story, the trajectory remains the same. It was higher initially, okay, went low, now it's slowly coming back. Okay, and the reason is the same because they've done capacity expansion, and right now they're not at their optimal utilization level yet. All right, okay. So now let's talk about some of the other working capital metrics like DSO, DIO, and DPO. So days sales of outstanding is a number of days the company takes to convert its credit sale into cash. Okay, basically how many days it takes for the company to receive cash payment from the customers. For so let's first estimate that because there's an interesting observation here. Account receivables. Where is it? Yeah, receivables divided by 2365. So you see, it's pretty low. It's 8 days, and now it's 9 days. So hospitals like Fortis and some of the large hospitals like Apollo, they have much higher days of sales outstanding, which means takes them longer to get cash payments from their customers. Why is it so? Because what is happening in India is the health insurance penetration is increasing. It's on the rise. So when customers they have their insurance companies pay for their medical treatments, and then so what happens is these insurance companies they don't pay right away. They take their own sweet time, right? So it impacts their days of sales outstanding, right? But it seems that this particular company, Kowai, this hospital has done a fairly good job at keeping its uh, account receivables or days of sales in control. Okay, but I'm expecting it to rise in the future with increasing health insurance penetration. Okay, all right. Now let's DIO. DIO is again, so inventory for them is is medical supplies, medicines, pharmacy, and and the food items in canteen. That's what makes up inventory. So let's calculate DIO. DIO is the number of days it takes for them to convert their inventory into sales. All right. So inventory, same way we'll calculate. The only difference is it's inventory divided by uh, cost of goods sold. You could also do it divided by sales. A lot of I've seen in the industry, a lot of people they use sales instead of COGS, which is totally okay. They just want to be consistent. They just want to use sales across all the working capital metrics, which is fine as well. But I'm just being consistent with the actual definition of DIO. Okay, all right. So and then DPO is number of days it takes for a company to pay back their suppliers. All right. So let's estimate this as well. It's days of. So let me where are the payables? Yeah. COGS into 365. So it's pretty high. It's higher than DSO and DIO, suggesting that they actually have they take right now they're taking like 35 days, okay, to pay back the suppliers. Okay? So they have good negotiating power over the suppliers. All right. And same is the case with other big hospitals as well, that they take in fact they take more time, if I'm remembering correctly, to kind of pay back their suppliers. Okay. And if they if companies take a lot of time to pay back the suppliers, it's actually has a positive impact on their enterprise value, because the working capital requirement reduces. All right. So because if you look at the cash conversion cycle, it's DSO plus DIO minus DPO, and you'd ask, all right, what is cash conversion cycle? Cash conversion cycle really is the days it takes a company to convert its investment in it's basically, sorry, the days it takes a company to convert resources into cash post the sale has been made. Right. So if you see, they have negative uh, cash conversion cycle. All right. So it means that that inventory is sold before they pay for it. All right. So that means the suppliers, in the true sense, what it means, suppliers are actually funding their you know, their business operations, so to speak. That's what it means. All right. And most, a lot of hospitals I've seen, they have actually negative cash conversion cycles. All right. Now, with all of this estimated, let's, all right. Now let's talk about solvency. So solvency means it measures a company's ability to meet its long-term obligations, right? Uh, and I know we didn't cover current ratio per se, but we did talk about working capital. So current ratio, quick ratio measures the company's ability to meet its short-term obligations. Solvency, on the other hand, measures the company's ability to meet its long-term applications. So we looked at capital structure and not solely focus on capital, current assets and liabilities alone in solvency. All right. So there are two ratios that I think they're important to cover in solvency. One is total debt by total equity. Okay. You would have, I'm sure you would have heard of this. So so what's the total debt? Let me add all the debt components. Loan, I'll also include these liabilities, but because technically it's a debt, and then short-term debt as well. Okay. So that's overall debt divided by equity. So what's my equity? My equity is this, right? All right. So you see it was lower than 0.6, shot up to over 1 because they took a lot of debt, paid it down, and now they are at zero point 0.7. Okay. So interest coverage. Now this is interest coverage ratio. Uh, it measures a company's ability to pay off the interest on its debt using through its business operations. You know, through the profit that they make uh, through their business operation. That's what interest coverage ratio is. And let me tell you, this is also one of the key ratios that is used by credit agencies to determine the company's credit rating. All right. There are like, they use D by E as well, but what I know is that ICR is perhaps one of the most important ratios that used by rating agencies to determine the company's credit profile. All right. And if a company, so first let me derive it and then let me comment on their ICR, interest coverage ratio. So EBIT is this divided by interest. Okay. Yeah, it's pretty comfortable. Yeah, it's comfortable. So it's above 9, above 10. Now it's above 6. All right. So see, with ICR, with coverage ratio, if you are above 3 or above 4, then that's great. Okay. But if you are say below 2, you are certainly inching closer to the default area. In fact, if you're lower than 1, then you are in the default area. Because if you're lower than 1, that means your interest costs are more than your operating income. Your operating income is not sufficient to meet your interest payment. All right. So, all right, but they seem pretty like in a good shape if you look at ICR. Okay. All right. Now let's talk about return ratio. All right. So, uh, there are two ways I want to. All right. So now let's talk about the return ratios. So everything that we've done until now, okay, uh, profitability, efficiency, and solvency capital structure, all of these three things combined, they actually give you the return ratios. All right. In fact, we have used a function. Let's say the function was ROE is a function of profits, uh, efficiency, and capital structure. Okay. So DuPont formula, what it does is it actually defines the function, defines the relationship that ROE has with all these three, uh, three things that we discussed: profitability, efficiency, and uh, capital structure. All right. Okay. So the formula is, if we just break, what is ROE? ROE is backed by equity, and then let's multiply it by sales, divided by sales itself, and then let's multiply it by assets, divided by assets itself. So this gives us the same thing as this, right? Because sales divided by sales, assets divided by assets. Now let's rearrange. Okay, so it's PAT divided by sales. Okay, that's 1 into, so that's basically profit margin PAT by sales, and then sales divided by assets. What is it? Asset turnover, right? That's, we've already estimated up top. Okay. The third is assets divided by equity, and this is called leverage. Okay, so ROE basically is net profit margin, or PAT, into asset turnover ratio into leverage. That's what it is. So all these three things: profitability, asset turnover. I know we didn't estimate PAT. We'll do it right now. So PAT is, let me just put PAT here. PAT margin. PAT margin is divided by sales. Let's take a look at, because we're talking about PAT. So let's, where did it go? Sorry. This is a PAT. All right. Let me mark this in yellow. And then this line item here, PAT into asset turnover into leverage. Okay. So leverage is basically asset divided by equity. So it's 1 plus debt by equity. That's what leverage is, right? So my assets, my total assets divided by total equity is 2.1 bracket. Okay. So it's above 2 all the way, right? So now let me estimate ROE using the DuPont formula. So it is, let me highlight this as well. All right. So ROE is PAT margin into asset turnover into leverage. Okay. All right. Now let me estimate ROE using the simple formula, that is PAT divided by equity. Right. So it is PAT divided by equity. So you see, it is exactly the same as the one that we got here. All right. So see, this DuPont kind of helps us explain as to why ROE is is trending the way it is. All right. So you see ROE was high early on, and then it was again high in 2020, and then it dropped. Okay. All right. So it was high, okay, because of asset turnover, because they were sweating, they were operating at a good utilization level. Okay. Then they did a lot of capacity expansion, okay, which resulted into this asset turnover going down, okay, which resulted in a low ROE, all right, which is what you see here, right? Okay, and the reason why we see that 2020 it kind of spiked up, and the reason is you see margins in this particular year, they're high, okay, so it kind of more than offsetted the low asset turnover, okay, and also leverage in that year was high. So leverage, you would not really want ROE or the return ratios in an ideal scenario to be high because of leverage, you know. And the reason why they took a lot of debt, they actually had a lot of debt in this year, okay, so which actually uh, helped increase the ROE. But you would not really, as I said, you would not want the return ratios to increase because of high leverage. Okay, you would have to analyze why it is increasing if it is increasing. If it is because of asset turnover or margin, then yeah, that's good. All right. Okay. All right. So so with this, now let's also look at return on invested capital. Okay. Return on invested capital is, let me use this invested capital because we did the hard work. All right. So now let's estimate the ROIC, return on invested capital. So we already have the EBIT here divided by invested capital. Invested capital, we've done a lot of hard work to estimate. All right. Okay. So this is the invested capital. So before again we comment on ROIC, let's again apply DuPont and ROIC. Okay. By the way, it has very similar trends as ROE. Okay. But let's first estimate ROIC using the DuPont formula, which is again it's the same. It's, but instead of PAT margin, it's operating margin, which is EBIT divided by sales. By the way, this is pre-tax ROIC. This is not post-tax. This is pre-tax ROIC to operating margin into capital efficiency, which is sales by invested capital. All right. So let's multiply the two things together. Okay. So those two things are your EBIT margin. Let me put them on a different color. Let me put sales, capital efficiency in a different color. We're going to multiply these two things together, right? Right. So you see ROIC matches exactly what we've estimated. Okay. And the trend is it was high early on, okay, went downhill, and now it's slightly recovering. Okay. And by the way, you may ask, why did not we use capital structure, or the leverage? Because you don't have to, okay? Because you're talking about ROIC, it already has the capital structure baked into it. It has both equity and debt components. In ROE, you just had equity, you did not have debt. So you had to include leverage in the equation. In ROIC, okay, you already, in your invested capital, you already have the debt component baked in. Okay, that's why you don't have to explicitly introduce the leverage component. It's already there. All right. Okay. Now let's see why it was high and then it went downhill and now it's slowly recovering. Same logic would apply, I guess. So again, yeah, if you see the margins, uh, you know, the EBIT margin 16, then 15, then again it's rising now. Okay. It's because we've already discussed at length early on, because operating leverage is playing out. They have some pricing power. Okay. But capital efficiency, okay, they had high capital efficiency early on, but really went down from 1.45 to as low as 0.7, and now it's slowly recovering. Okay. So again, I think the heart of the reason really is because they eventually need to kind of get to optimal levels of capacity utilization. Okay. And if we see here, their occupancy level, which is obviously a very good indicator of the utilization levels, 70%, now it's as low as 55%. Okay. That's one. We are talking about the bed occupancy, because even the medical college, right now it's in its fourth year of operation in year 2024. Then it will have 5 batches operating. Okay. Right. Then again, so we should have like good measure of occupancy and utilization next year. Right. All right. So hopefully this exercise helped. Uh, and Yes, so the next logical segue really is for us to kind of use all of this information and then project these ratios, these metrics in the future, and value the firm, value the business. Okay, so I'm going to make a video on valuation of this healthcare provider in this hospital, and after that, I would do financial statement analysis and valuation for companies operating in other industries as well. Well, hopefully you learned something. If you have any questions, please let me know, and I'll be happy to share this spreadsheet with you if in case you need it. All right. Thank you.